Good evening, everyone. Once again, welcome to our third session. I believe this is the most popular of them all in terms of the size of money that we manage. Before I start this session, I just wanted to highlight one important point about the hybrid team that we have, hybrid and solutions team that we have. It is very unique to the industry. There is a reason why we have chosen it to be different, because we do believe that there are different skill sets which are required to manage risk adjusted as a category. To kick off this session, we have with us our co-head for this team, Bharat Lahoti and Bhavesh Jain. Together they have almost 30 years of investing experience. They're also joined by their colleagues in the team who co-manages this entire space. I would first request Bhavesh and Bharat to introduce their team before we kick off the questions and get on with the session. Bhavesh.
Thanks, Deepak. Just to introduce our team, obviously Bhavesh has been there with Edelweiss for a long period of time. I've been also there since last 6 years in Edelweiss. We have been also associated with two of the bright minds in the market, if you look at it, and they are handling different set of pieces. We have Noor, who handles our quant piece, since we run asset allocation model, which is very important. We also run a lot of funds from a process-oriented approach to a quantitative space. So this is one of the space where he handles a lot of things. We have Ashish Sood, who handles a lot of fundamental activities, since a lot of our quant investments is driven by fundamental approach. So Ashish helps out in that context.
So let's get going with the questions, Bhavesh. The first one is a very basic question. What is the investment approach that you follow in the Balanced Advantage Fund? If you can just clarify it for our investors and people who may not have really invested so far.
Thanks, Deepak. See, in Balanced Advantage Fund, what we try to do is manage this money to give equity-like return with limited amount of volatility. You will see the fund invest almost 80% of its AUM into equity and 20% into debt. The 80% which is deployed in equity is managed dynamically, depending on our asset allocation model. So sometime our equity can go down to as low as 30%, and the maximum we can go is up to 80%. Remaining 20% always goes into debt, where we manage debt in a very simple approach. We have GSEC, we have T-bills, and we have short-term papers, but strictly AAA rated. As far as equity bucket is concerned, we deploy mostly into large cap names and strong companies with clear on corporate governance. So this is how our equity deployment is taking place. Now, coming to the important piece, which is the asset allocation model we follow, which internally is known as Edelweiss Equity Health Indicator. Here, we try to use a market trend, health of the trend, and basis that we decide how much equity we have to keep in on a daily basis. Now, broadly, if you will see in market, most of the Balanced Advantage Fund uses the most, you can say, common approach, which we all have heard of, that is known as valuation-based asset allocation model. We are slightly different. We follow a pro-cyclical approach. And obviously, each you can say asset allocation model have their own advantages and disadvantages. But we have choose to use the pro-cyclical one and not the, you can say, the common one like counter-cyclical.
So interesting, you mentioned about 30 to 80%. How has this asset allocation played out in recent times, over last 1 year specifically, and maybe over last 3 years, if you want to highlight that, and how it has really helped the performance?
Sure. You will have seen markets have become more and more volatile in recent times. We started with US about to increase their interest rate. Then we saw our own union budget. We saw multiple state election. After that, we saw this one important event between Russia and Ukraine, which led to a lot of volatility, not only in our market, but globally also, and across asset classes. And obviously, with this amount of volatility, our asset allocation model also have gone under tremendous changes. You will see in October 21, we were running almost 70% equity. So it is the maximum we can go. We were almost at 70%. From 70, by beginning of March, we were at 35% equity. By end of March, we went up to 63, and today, as we speak, we are closer to 55. So a lot of changes have happened to this asset allocation in last 6 months. And similarly, if you will see for last 3 years also, we started with COVID, then lockdown and all that stuff, and we saw lower circuits into market. And after that, we saw a lot of stimulus by both, you can say, central banks as well as government promising that they will do whatever it takes to protect their economy. So all these things led to a decent run up in the market. But overall, now when we look at last 6 month performance or last 3 years performance, one thing which is clearly showing up that our nimble approach, or as far as our asset allocation model is concerned, has helped us to relatively outperform most of the peers in our category, and with a reasonable alpha of say close to 3 to 5% across time period. And most importantly, if you will see in last 1 year also, Nifty is up close to 20%. We have delivered around 14% return. But return is just one part of the story. You will see we have reduced volatility, we have reduced drawdown by almost 50 to 60%. And as far as returns are concerned, we are still delivering almost, you can say, returns in the range of 70 to 100% of what Nifty is delivering. So on a risk-adjusted basis, I think we have been able to deliver excellent amount of, you can say, excellent numbers, both in the shorter period of last 6 months to 1 year, as well as longer period of 3 years and 5 years.
Thanks, Bhavesh. You mentioned equity-like returns, so it's important to look at the underlying, and especially in the context that we live in today, where interest rates, after being so low for a very considerable period of time, are seeing some changes, etc. So in that context, how would you define the core philosophy that you follow for your long-only portfolio? And if you could throw some light on overweight positions or underweight positions.
Sure, Deepak. Obviously, equity investment is almost 80% of our AUM, and that is, you can say, the most important piece. Looking at the way environment has changed over last, or you can say 1 year or so, accordingly, we have also changed stance in our portfolio. Normally, we follow quality and growth at a reasonable price as an approach for our equity investment. But you will see in recent changes due to, you can say, Russia-Ukraine issues, US Fed increasing rates, we have made small adjustment to our portfolio also. So in fact, you will see of late, we have started reducing some weight into IT sector. We have also, in current environment where global volatility is definitely going to increase, we think that focusing more on domestic play is going to help. And that's why we have increased exposure to capital goods because we see a lot of, you can say, uptick in orders. Similarly, we are seeing because of decent cash flows, many companies have been able to improve their balance sheet. In addition to that, if you'll see, government has also announced increasing capex in their recent budget. So all these things are good for increasing weight to capital goods. In addition to that, we are also overweight on selective metals name because I think some of the metal stocks have decent advantage in given, you can say, demand supply situation. They will be able to deliver a much better number. So we have slightly increased our weight over there also. Now, as far as our fixed income investment is concerned, as we all are expecting interest rates to go up, looking at inflation number, we have decided to keep low to medium duration and strictly AAA rated papers in our portfolio.
Let me just throw the last question before I move on to Bharat. You mentioned about the model being different. If you could throw some more light on how the model is different and perhaps why you chose this model and for how long you have been running this.
I think this is one of the most important question, and I think we should get greater clarity on this to the larger audience. Most of the balanced advantage fund in industry uses different asset allocation model, but broadly you can divide them into two. One is a pro-cyclical approach. In simple term, it is known as trend-based hedging, which is followed by Edelweiss. And second is the counter-cyclical approach, or in layman term, you can say valuation-based asset allocation model, which is used by most of the players in the industry. So you would have heard words like price to earning, price to book, dividend yield, yield gap analysis. Different, you can say, funds use different terminology, but in simple term, that is nothing but valuation-based hedging. Now, each model have their own advantage and have their own disadvantages. There is no model which will work across market cycle. So normally what we have seen over last, you can say, 5 years of our live experience, all the models which follows valuation based approach, they normally tends to outperform in the range bound market. Like you will see in last 8 odd months, Nifty is hovering around 17,000 to 17,500 range. So valuation-based model will definitely do better in this kind of environment. But at the same time, if you will see India as a market, it is an high beta market, and if you will see historically, most of the times our markets are trending. And when we say trending, it can be bullish trend or it can be bearish trend. So whenever markets will be trending, a trend-based hedging approach which we use will tend to outperform a valuation-based approach. Same thing is visible in last 5 year also. If you will see, Deepak, in last 5 year, we have seen 3 years where markets were bullish trending. So 2017, Nifty was up almost, you can say 20% plus. Then 2020, Nifty was again up 15%. 2021, Nifty was again up close to 24%. And that's why, because most of the time markets were trending, our equity exposure was relatively higher compared to our peers, and that is visible in performance also. So we have outperformed most of the players in the category on an average by 3 to 5%, purely because of our asset allocation model. Again, this number is not limited to last 5 years. If you take data for last 10 years, last 15 years, last 20 years, picture doesn't change. 75% of the time, that is 3 out of every 4 years, markets have remained trending and suitable to our investment style or our asset allocation style. And less than 25% of the time, that means 1 out of 4 years, markets have been non-trending. When I say non-trending, that means markets are in the range of, you can say, plus or minus 5%, plus or minus 7%, or in simple term, are giving you single digit return. So you take data for last 5 years, you take data for last 20 years, I think the ratio remains more or less same. And as a result, over a long period of time, I think our asset allocation model have that, you can say, advantage, inbuilt advantage of at least, say, close to 3% to 4% alpha on a CAGR basis compared to other valuation-based model.
Thanks a lot, Bhavesh. The passion is clearly visible. Let me come back to you with audience questions. But let's start talking to Bharat. Bharat Lahoti manages our Edelweiss Recently listed IPO fund. Just to give some context about this fund was launched 4.5 years ago. Again, when there was a huge IPO frenzy, to provide a solution-based approach towards investing in IPOs or companies which are coming for listing afresh. I'll ask Bharat about it to give us more context and what kind of a problem that this fund really solves. But Bharat, what a journey. 2, 3 bull and bear cycles already seen. How would you really describe this experience?
To just give you some sense about it, how actually IPO market behaves, IPO market works also in cycles. So if you look at it, we had a good 2017 year kind of stuff when IPO markets were again booming. 18-19 was a bit bearish phase in context of it, and consequently again we have seen IPO markets picking up in 2021. Now if you look at 2021, it was one of the biggest eventful year for IPOs, both Indian context and domestic markets, and globally also. So second thing which is important, it's not only about the number of IPOs which has came in, it is also about the amount of money which has been raised during this IPO. It's been multi-year high kind of stuff. If you look at just in Indian context, 63 IPOs came for listing, and finally around 1.2 lakh crores of money was raised during that. And if you look at, there was an average listing gain of around 21% for IPOs. So this has been extremely eventful year from IPO perspective. Just to give you a few more context about it, why this year was also interesting from it, you would see at least 40% of money which was actually raised actually was for primary issuance. Now, when you compare it with historical context, over last couple of years, it was 20% amount. So this money is broadly actually for growth capital, for strengthening the balance sheet of companies. So that is one important thing. Second interesting data point is that even after listing, there has been average listing gain of 15% for next 6 months in IPO stocks. So that is also interesting fact which people think about it. The third important thing, which is contrary to popular belief, that the IPOs is all about internet companies. But if you look at the number of companies which have come for IPOs, the sectoral diversification, it has been pretty much bare. We had 9 companies coming in the BFSI space, 8 companies coming in chemical space, 7 companies coming in the pharma and healthcare space, 6 companies coming in autos, and 6 companies in retail. So it's been fairly diversified. The internet companies, if you look at it, has been only 8 out of 63. So it's barely that kind of stuff. So that is how the IPO markets have behaved over last year to that context.
So the recent nervousness, what would you attribute it to, and would you really look at it from a short-term or a long-term perspective, from an investing perspective?
Okay, so as we move towards the FY22, obviously there has been cautious optimism in IPO market. Given the backdrop, what happened in the macro environment, Bhavesh has alluded some of the facts, and Trideep in his previous commentary has also alluded how the macro environment has dramatically changed over last 6 months. Given that most of the IPO market is always correlated to what happens in the equity market, there has been some implication on the IPO market. But having said so, over last couple of months, if you look at it, market have started stabilizing, and we would see IPO market again rebounding. That is one part of it. Second part of it, if you look at it in historical context, on an average, you always see like 20 to 25 IPOs coming in a year. If you go by calendar year 22, we already have seen 6 IPOs already there. Couple of IPOs may be lined up for next week, and maybe few more in next month. So broadly, we are pretty much on the track. If you look at the pipeline of IPOs in terms of the DRHP being filed out, there has been 100 plus DRHP been filed out across sectors. And if you look at it, they are at a various stage of approvals and discussion which are going on. So it's a pretty much tight IPO season, which I think could be happening for FY20 calendar year 22 as well, kind of stuff. If you look at the discussion which is happening between the investors and the companies who are going to come for IPO, most of the people have actually rationalized their expectations, both investors and companies. Consequently, you would see actually more reasonable pricing happening for IPOs going forward. Also, with the regulation changes in the IPO, which the SEBI has brought in with respect to the allocation for HNIs, higher investment time limit for anchor allocation on IPO funding, a lot of sanity was going to prevail in IPO market going forward.
Thanks, Bharat. What has really helped the performance of the IPO fund recently, and what are the major changes that you have made over the last 1 year in the portfolio?
So the approach has broadly remained same for the way we have managed IPO fund for last 4.5 years, kind of stuff. Nothing has dramatically changed to that extent. The 5 basic principles what we have followed in this IPO fund has remained the way it is. First is a systematic way of investment. When we say systematic, it's a process-oriented way. Now, if you look at it, most of the IPOs would be mid-cap and small-cap, but we have categorically kept it a more multi-capish in nature. So we have actually a mix of large cap, mid cap, small cap in our portfolio. Second important thing which we have done for the portfolio perspective is that we have actually broken down the IPO universe into 3 different buckets, which is secular ideas, cyclical ideas, and avoid ideas. And our focus always lies to have a higher weightage to the secular growth ideas. If you look at it, the current portfolio, almost more than 75% of ideas are in secular bets. So those are 2 things which we have done in terms of process-oriented investment. Second important thing which we do in terms of principle is that we have to be extremely selective. So if you look at it, last year 63 IPO came in, we actually participated only in 24. So extremely selectiveness has helped this fund. The third important fact is that we think about long-term, about how the company is going to behave in long term and not just on listing day perspective. So if you look at our average holding period for this fund has been more than 2 years. And finally, if you look at it, there are 2 more basic principles which we are talking about is about sectoral diversification. One has to be extremely conscious about it. How do you diversify your portfolios? And if you look at it, our portfolio is well diversified across various segments. If you look at it, BFSI, retail, consumer, technology, I'm just saying it's been well diversified. And finally, if you look at the 5th principle which we are following is that don't buy everything on the day of IPO. You can buy gradually over time. So we build position gradually as and when the company announces results and so on and so forth. So that's how been the principle and which has worked well for this fund over last 1 year.
So Bharat, you already answered my next question with regards to sectors and businesses, but if in particular, if you wanted to highlight something which you see that may change over the next 12 months from a sector or business perspective.
Okay, so let me give you some sense about it, how actually we think about sectors and why this is very important. If you look at though we have well diversified sectors within the portfolio, but the theme what we actually work around is very different from the regular flexi cap funds. So you would see actually within the BFSI, we have not only private banks, we have AMCs, wealth management house, we have platform-based companies, we have insurance companies. Even in the case of retail, we have groceries, footwear. We have a lot of other stuff in that category. So we have a well-diversified theme to play around within that basket.
Thank you so much, Bharat. Right on the queue. We'll take a few audience questions. Bhavesh, let me come back to you. There is a perception or belief among a set of investors and advisors that Edelweiss Balanced Advantage Fund, since it follows a different model, is more risky than others. How do you really answer that question?
I think again, one very important question, and I'll say not question, but one of the biggest myth which need to be, you can say, busted, and obviously we will bust this myth with a lot of data we have. You will see in last 5 years, majority of the time, equity has outperformed debt. You take 2017, 2019, 2020, and 2021. That means 4 out of last 5 years, equity did better than debt. And the basic approach of any asset allocation model is to have higher weightage to asset class which will outperform. Now obviously 80% of the time equity has delivered better return than debt. So by default we should have higher allocation to equity. But having higher allocation to equity not necessarily means that we are more aggressive or we are more risky. I think the only time, you can say fortunately or unfortunately, in last 5 years, which all the Balanced Advantage Fund got to showcase their real talent of protecting downside was in February, March 2020. Because I think in last 5 years or in fact in last 10 years, that was the only bear market which we all have witnessed. Now in that period, if you will see from top of 12,400 to bottom of 7,600, Nifty corrected by almost 39%. And in that fall, Edelweiss Balanced Advantage Fund, which people normally think is aggressive or high risky, because in January 2020, we were running 70% equity. But when you will see the actual number, Nifty corrected by almost 39%, we were down only 14.8%. Now, in the same period, if you will take some of the, I'll not take the name, but some of the larger Balanced Advantage Fund, or you can say the oldest one in the industry, all of them were down anywhere between 25 to 27%. So I think the data is visible. The other way to look at risk is you look at standard deviation, you look at drawdown, you look at say Sharpe ratio, you look at beta of the portfolio. In all parameter across time period, Edelweiss will be amongst, you can say, top quartile as far as risk is concerned. And obviously returns we have already discussed. You will find us on the top quartile on the return chart also. So obviously this is a myth, and I think we will be more than happy to share more data as and when demanded by audience that we are not the riskier Balanced Advantage Fund. In fact, we are one of the most conservative and to that extent you can say least volatile Balanced Advantage Fund.
So let me just use the marketing tagline, Bharat bhi or Bachat bhi. So thank you, Bhavesh. Bharat, I just wanted to ask this question. I had to ask this question. On 1st of February, Edelweiss restricted inflows into the IPO fund, which was removed on 1st of April. What really made you change, take both the decisions? First was restricting the flows, and then now allowing the flows above 1 lakh per day that you put.
So two things, obviously, if you look at it, one of the important thing is that market volatility was pretty high. And if you look at it, the IPO market was going through a troubled time. Globally, I'm just saying not in Indian context, but globally, if you look at it. So as and when we saw that market volatility is pretty high, we thought let's look at the fund more deeply. Secondly is about the liquidity. We always spoke about it. This fund is a limited opportunity fund, given the fact that the free float of many of the IPO stocks is very limited. Consequently, we have to keep an extreme eye on the liquidity of the fund. So we thought in this kind of volatile market, we need to keep two things in mind. One is the liquidity of the fund, and the second is how do you manage the volatility over the period of time. So that's the reason in January 2022, we actually stopped lump sum investment to that extent, and we actually did only 1 lakh kind of investment allowed per day kind of stuff. as soon as March came in, a lot of the volatility had actually subsided, and consequently we re-looked at this fund, given now the new liquidity profile, and given the pipeline of IPOs which I spoke about in my previous comment, we think opportunities are pretty much high from that context, and consequently we opened up the fund from that perspective.
So thanks a lot. It was really a bold call to take when you were receiving flows to the tune of 150 crores a month, and now reopening at an appropriate time for investors. Bhavesh, one last question for you, maybe a couple of them. One is with regards to comparisons that are drawn between dynamic managed balanced advantage fund versus the static aggressive hybrid fund. How would you like to position it within the team, and how do you see it as a tool of investment?
Sure. So you will see our team manage hybrid funds starting from pure arbitrage. So other than that, we also have equity saving fund, balanced advantage fund, and aggressive hybrid fund. Now, between you can say balanced advantage fund and aggressive hybrid fund, maybe after 3 year, 5 year, both of them will deliver similar return. But as I told you, the volatility is something which has to be taken care of. And that's why a balanced advantage fund have its own importance. And aggressive hybrid fund is suitable to those set of investors who are ready to take or who are ready to digest this kind of volatility. For us, I think both the funds are suitable to different sets of investors. Earlier, people used to say that balanced advantage fund is purely tactical in nature, but now we have ample data to showcase that a balanced advantage fund is no longer a tactical play, but becomes a core part of your portfolio. I think aggressive hybrid fund over a period of time, you will see start replacing large cap allocation in some of your clients' portfolio because it has been observed, if you see data for last 5 years, last 7 years, last 10 years, return of aggressive hybrid fund and return of large cap fund or more or less is same. But large cap fund have slightly higher volatility compared to your aggressive hybrid fund. So I think there will be, as it becomes more and more difficult to generate alpha in large cap space, I think aggressive hybrid is there to capture that space with lower amount of volatility.
Questions are flowing in. I have only time for two more perhaps. One question is on the arbitrage fund. The question is perhaps, can this be treated as some kind of emergency corpus fund? How would you like to explain or really throw light on this kind of a positioning?
So Deepak, normally you will see people tend to keep at least 5 to 10% of their portfolio into liquid fund or short-term FDs or maybe some very liquid instrument purely to meet any contingency. Now, earlier people were not aware of arbitrage fund, but now the category is almost 1 lakh crore plus, and it has shown time and again that this is one of the most tax efficient way to park your short-term liquidity. You get better return, and in fact, it is not only return, on the other hand, you reduce your risk substantially. Even the safest fixed income product is, say, for example, liquid fund. You have entire 100 rupees exposed to short-term papers. So there is all kind of risk associated with that, even on that 100% of, you can say, relatively safer instruments. As far as arbitrage is concerned, almost 75% of your 70 to 75% of your portfolio is into cash future arbitrage, where there is zero counterparty risk, zero credit risk. Almost 20 to 25% is in T-bills and GSEC for your margin requirement, and risk, or you can say counterparty risk or credit risk, is limited to only 5 to 7% of your portfolio, which you put in short-term papers. And obviously, because of taxation advantage, because arbitrage being an equity fund, that advantage is always with you. So I think it is good to park all investment which have visibility of at least 1 month because arbitrage fund have an exit load of up to 30 days. So any liquidity which you have for more than 30 days and maybe up to as high as 1 year, a couple of years also can be parked into arbitrage fund.
Thanks a lot, gentlemen. Let me just answer this question, which has come up many a times during today's discussion. Whether a balanced advantage fund can be treated as a good substitute for a retirement or an annuity product. I think it's a brilliant idea. Gone are the days where you used to work for 40, 45 years and then the retirement period was only 15, 20. We are living longer. Data suggests that countries, not just in Japan or rest of the world, even in India, when we started during the time of independence, our average living age was 52, it has moved to 70, and data suggests that it will go upwards only. So you are living longer and you are working shorter. So it's important that returns that you generate from your retirement corpus are higher, and fixed income perhaps can't solve that problem alone. So you need that additional kicker of equity, where at the same time you do not want the volatility to kick in at the same force. So as Bhavish pointed out, that balanced advantage funds as a category really can solve that problem from a risk adjusted perspective. So thank you everyone for sending in your questions. For the paucity of time, I have not been able to take all those questions, but we will try and reach out to all of you in any which way we can. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.